If you watched our last video, you already know SCHD paid $0.2525 per share in June. Many of you did the math right there in the comments. Some collected $9, others collected over $2,000. But a few of you caught something sharper than the headline number. That payment was actually a touch below what SCHD paid a year earlier, and that is not a one-time blip. It is the second straight quarter this has happened. So today we're tackling that concern head-on. Why the growth rate cooled, what it actually signals about the fund underneath, whether this changes anything about holding it for the long run, and what smart investors should be watching over the next 2 quarters. Let's get into it. Before we go further, this video is for educational purposes only. I am not a licensed financial advisor. All the data is from publicly available sources, so please verify the numbers yourself and consult a qualified professional for your own situation. Here is the confirmed data, and I want to walk you through it carefully because the details matter. SCHD's Q2 2026 payment of $0.2525 per share came in slightly under the $0.26 paid in Q2 of the year before. Q1 2026 showed the same pattern against its own year-earlier comparison. 2 consecutive quarters, both landing below where they stood 12 months prior. If you have been watching your own account and noticed the number barely move, or even dip slightly, you read it correctly. This is not a misunderstanding on your part, and it is not a rounding quirk. It is a real documented shift showing up plainly in the numbers, and pretending otherwise would not serve you. Here is why it happened. Because the reason matters far more than the figure itself. Over the past 5 years, this fund's payout climbed at an average pace above 11% annually. That is a strong number by almost any standard. Meanwhile, the share price surged even faster during that stretch, up close to 19% so far this year alone, and over 25% across the trailing 12 months. When price growth outruns income growth for long enough, the two eventually have to realign with each other. Either the climb in price eases off, the payout accelerates again to catch up, or some blend of both happens gradually over time. Right now, what we are watching is the income side of that equation settling down rather than the price side pulling back. That is not automatically a warning sign. It looks much more like a fund maturing into a steadier phase. Explosive, double-digit payout increases rarely continue forever. Not in this fund, not in any company, not in any income strategy you will ever study. What usually happens instead is a gradual convergence toward the actual earnings growth of the businesses sitting underneath the fund. The energy producers, the healthcare firms, and the consumer staples names that make up most of this particular portfolio. Those companies are not shrinking or struggling. They're simply not raising what they hand back to shareholders at the explosive rate they once did a few years back. And the fund's quarterly distribution reflects that reality directly, quarter after quarter. Here's the mistake to avoid on both sides of this conversation. Do not assume a flatter payout means something underneath is broken. Do not assume it will snap back to a double-digit pace automatically either, just because it did before. Both of those reactions miss the actual point being made here. The smarter approach is tracking 2 specific signals as we move forward. First, the payout ratio of the underlying holdings. Are these companies still earning comfortably more than what they distribute to shareholders each quarter? Second, the next scheduled distribution announcement, which will reveal whether this cooling period is a short pause tied to timing quirks inside the index, or the beginning of a longer, slower chapter for this fund's income story. Now let's talk about what this actually means for your own money sitting in this position. If DRIP is switched on inside your account, nothing about your approach needs to shift today because of this news. Shares you have already purchased keep compounding regardless of this quarter's headline number, and that mechanism does not pause just because growth slowed. What does need adjusting is your forward assumption for planning purposes. Projecting future income off an 11% annual pace when the trailing data now shows something closer to flat sets you up for a disappointing surprise later on. Modeling a more conservative, sustainable growth rate instead protects your retirement math from that rude awakening. And frankly, it is simply a more realistic way to plan around a real fund rather than a best-case scenario. It's worth remembering that the total return story here remains strong, even as the income story cools off beside it. This fund is still up meaningfully more than the broader market this year, driven largely by price appreciation in the businesses it holds rather than by the size of the distribution itself. Price growth and income growth do not always move in lockstep with one another. Right now, one side of this equation is carrying more of the weight while the other side catches its breath before its next move. There is a bigger lesson sitting underneath all of this, and it applies well beyond just this one fund. A fund's price chart and its underlying cash engine are two separate stories entirely, and confusing the two is exactly how investors end up blindsided later. You can be up double digits on paper while the actual income stream barely moves at all. And both of those facts can be true at the exact same time without contradicting each other in any way. Learning to watch both signals separately, rather than assuming one always confirms the other, is one of the more valuable habits a long-term income investor can build over the years. It also helps to zoom out and remember why this fund screens its holdings so strictly in the first place. Every company inside this portfolio has to pass a test for cash flow, strength, balance sheet health, and a track record for paying reliably for at least a decade before it is even considered for inclusion. That screening process is designed to protect you from companies that overpromise on their payout and then get forced to cut it during a downturn. A slower growth rate from a well-screened fund is a very different situation than a shrinking payout from a fund chasing yield, without any real quality filter behind it. Here's your action item for this week. Pull your own last 4 per share payments, not the dollar totals landing into your account, but the actual per share figures themselves, and lay them side by side on a notepad or spreadsheet. If the same cooling pattern shows up clearly in your own account, that confirms you're reading this trend correctly, and it is a solid reason to keep your future expectations grounded rather than assuming past pace continues on indefinitely without end. Drop those 4 numbers directly in the comments below. I genuinely want to see how widespread this exact pattern looks across many different portfolios and account sizes. The next scheduled distribution announcement will be the real test of whether this cooling period is temporary or the new normal going forward from here. Subscribe so you are already here when that number lands, because it will answer the exact question a lot of you are asking me right now in the comments section. I'll see you in the next one.